Hello and welcome to this live webcast on academic research opportunities related to IFRS 9 financial instruments. Thank you for joining us. My name is Anna Simpson and I'm joined here today by Anne Tarka, a member of the International Accounting Standards Board, and my colleagues on the technical staff, Rihanna Weissner and Laura Kennedy. Just to note before we get started that the views we are going to express today are our own and they're not representative of the views of the IASB or the IFRS Foundation. Just to start with a brief overview of the structure of this webinar and also the purpose of this webinar. We have a 1-hour session today and we'll start with an introduction. Then we'll talk about two core areas of the IFRS 9 requirements, classification and measurement and impairment. In each section, we are going to provide an overview of the IFRS 9 requirements, and then we'll talk about related research opportunities. At the end of each section, we'll leave some time for questions from the audience. The purpose of this webinar is to engage academics and assist them with understanding the requirements of IFRS 9 and encourage research for the upcoming post-implementation review of IFRS 9. This webinar is one of a series of webinars. We are also holding similar webinars on IFRS 16 and IFRS 15, also with the purpose to encourage research for their upcoming post-implementation reviews. If you would like to ask a question during the webinar, please type your question in the question box and it will come through to us. A recording of this session will be available in due course, and the slides are already uploaded on the website. You can find them next to the registration link for the webinar. If I'm to provide an overview of IFRS 9 at a glance, before going into further detail into each of the two sections, I'll start with its publication in 2014. The board published the completed version of IFRS 9, which brought together the classification and measurement, impairment, and hedge accounting phases of the board's project to replace IAS 39. IFRS 9 became effective for annual periods beginning on or after 1st of January 2008, and the board has recently started its post-implementation review of the classification and measurement requirements. IFRS 9 is built on a logical, single classification and measurement approach for financial assets, and this approach reflects the business model in which the assets are managed and their cash flow characteristics. Built upon this is a forward-looking expected credit loss model that will result in more timely recognition of loan losses and is a single model applicable to all financial instruments subject to impairment accounting. The standard also includes hedge accounting requirements, a hedge accounting model that better links the economics of risk management with its accounting treatment, but we are not planning to talk about the hedge accounting model in today's session. The board is currently involved in a project on dynamic risk management, and while this project is still ongoing, companies can choose to continue using the IAS 39 hedge accounting requirements. And broadly on the research opportunities, before again we provide more detail in each of the two sections, First, the objective of the post-implementation review is to assess whether IFRS 9 is achieving its objectives and it is working as intended. And IFRS 9 brings many changes to accounting for financial instruments. So what is the evidence that would be useful and informative to the board that would come from research? Well, looking at the impact of all these changes brought about by IFRS 9 would be informative, and it is worth emphasizing here that it would be very useful to have evidence from studies that use a wide range of methods. Such studies would examine, for example, the changes in accounting practice by companies or the financial impact of these practices compared to post IFRS 9 application, and they would also examine the market effects. In other words, IFRS 9 related changes for market participants and the resulting market outcomes would be also informative to the board. Now, after this brief overview of the standard and the research opportunities, I will turn to Laura to talk to us in a bit more detail about classification and measurement.
Thank you very much, Anna, and hello to everyone. Okay. So classification determines how financial assets are accounted for in the financial statements, and in particular, how they're going to be measured on an ongoing basis. The objective of the classification and measurement requirements is to provide useful information about the timing, the amount, and the uncertainty of future cash flows by requiring entities to use an appropriate measurement basis. The classification approach is based on two considerations: business model, within which the assets are managed, and also their contractual cash flows. It's worth noting that actually a large portion of the debt financial assets of a traditional banking business are basic lending arrangements, and they continue to be measured at amortized costs under IFRS 9, as they were previously under IAS 39. This table shows the two considerations used for classification: what the objective of the business model is within which the assets are held, which focuses on how cash flows will be collected, and whether the asset's contractual cash flows are solely payments of principal and interest, or SPPI as we'll call it. To be measured at either amortized cost or at fair value through other comprehensive income, or OCI, the asset's contractual cash flows must be solely payments of principal and interest. In other words, the contractual cash flows are simple and they're consistent with a basic lending arrangement. If the business model is hold to collect, such assets are measured at amortized cost. If the business model is hold to both collect and to sell, the assets are measured at fair value through OCI. The fair value through OCI category results in fair value information being provided on the balance sheet, but amortized cost information being provided in profit or loss. And so users will get both types of information. All other business models, such as holding for trading purposes or managing on a fair value basis, will result in measurement at fair value through profit or loss. If the business model is neither hold to collect or hold to collect and sell, fair value information is increasingly important, and so is provided in both profit or loss and in the balance sheet. As well as this, cash flows other than SPPI also result in measurements at fair value through profit or loss. Amortized cost is a simple measurement technique. And so whilst it deals well with simple cash flows, it's fair value measurement that provides the most useful information about assets with more complicated cash flows. Despite these requirements we've just been through, an entity may designate a debt financial asset that would otherwise be measured at amortized cost or fair value through OCI, instead as fair value through profit or loss, if doing so eliminates or significantly reduces an accounting mismatch. Let's look at some key points now relating to the business model assessment. The business model refers to how an entity manages its financial assets in order to generate cash flows. By collecting contractual cash flows, by selling financial assets, or by doing both. This can typically be observed through the activities that the entity is undertaking to achieve its business objectives. As such, this means that a business model is a matter of fact rather than being an assertion. An entity needs to actively prove if the business model is hold to collect or sell. If it cannot do this, then the fair value through profit or loss measurement category acts as a default. Objective information such as business plans and how managers are compensated should be considered. And judgment needs to be used when assessing a business model, considering all relevant available evidence, but not considering scenarios that the entity does not reasonably expect will occur. For example, so-called stress case scenarios. A business model is not about an entity's intention for an individual asset. The business model should be determined on a level that reflects how groups of financial assets are managed together to achieve a particular business objective. Information about the level of sales activities, so for example, data on past sales or expectations about future sales, can provide evidence about the business model, and they should be considered. However, having some sales activity is not necessarily inconsistent with a hold-to-collect business model. Sales information does not on its own determine the business model and cannot be considered in isolation. Reclassification occurs only when there's been a change in the business model. And because the business model is closely aligned with how the entity generates its cash flows, such a change is expected to be rare. And those changes are determined by the senior management of an entity. The changes must be significant to the entity's operations, and the entity must be able to demonstrate those changes to external parties. To be measured at either amortized cost or at fair value through OCI, a debt financial asset's contractual cash flows must be solely payments of principal and interest. So let's look at what we mean by SPPI. In the context of assessing whether cash flows are SPPI, IFRS 9 says that principal is the fair value of the financial assets at initial recognition. This is the amount transferred by the previous holder, the amount at which you would recognise the asset. The contractual cash flows should be SPPI in relation to the initial carrying amount, because that will form the basis of the amortized cost measurement. IFRS 9 says that consideration for time value of money and credit risk are typically the most significant elements of interest. However, interest can also include compensation for other basic lending risks and costs, as well as a profit margin consistent with a basic lending arrangement. Contractual terms that introduce exposure to risks or volatility in cash flows unrelated to a basic lending arrangement, so for example, exposures to changes in equity prices or commodity prices, give rise to cash flows that are not SPPI. On this table, we've given a few basic examples of debt financial assets which have contractual cash flows that either are or are not solely payments of principal and interest. We're not planning to walk through these in this session, but we just wanted to give you some examples to take away. So I've just been talking about debt financial assets. I'll turn now to equity instruments. The default measurement for equity instruments is fair value through profit or loss. The fair value through OCI alternative is available for equity instruments which are not held for trading purposes. And that election would be made on an instrument by instrument basis. If the election is made, dividends will still be recognised in profit or loss. And there is no recycling of amount presented in OCI into profit or loss at any time, even upon the sale of the instrument. There is also no impairment. This removes a previous complexity that was associated with the available for sale equity instruments under the IAS 39 impairment model. Lastly, I'll touch on the classification of financial liabilities. When the board developed IFRS 9, the feedback it received on classifying and on measuring financial liabilities was that the requirements that were in IAS 39 were working well. And because of this, the treatment of financial liabilities was carried forward into IFRS 9 essentially unchanged. The only issue that the board was told needed urgent attention was around the volatility in profit or loss that was being caused by changes in credit risk of financial liabilities that an entity had elected to measure at fair value. This issue arose because the fair value of an entity's own debt is affected by changes in the entity's own credit risk. This means that when an entity's credit quality declines, the fair value of its liabilities fall. And so if those liabilities are measured at fair value, the gain is recognised in profit or loss. Many investors and others found this result as being counterintuitive and confusing. IFRS 9 therefore introduces new requirements to address this so-called own credit issue. The liability is still carried in the balance sheet at the full fair value, but the effects of changes in own credit on the fair value are presented in OCI rather than being presented in profit or loss. And amounts presented in OCI are not subsequently transferred to profit or loss. That was a pit stop overview. Anna, if I could pass on to you to talk a bit about the research opportunities in this area.
Thank you, Laura. So this slide and the next slide provide some examples of specific issues related to classification and measurement of financial instruments that the board is interested in. These are just examples of the topics that would be helpful to the board in informing its upcoming post-implementation review of IFRS 9. First, related to the removal of the available for sale category for equity instruments and the resulting no recycling of gains and losses through profit or loss if entities choose the OCI presentation election. Related question to this that would be of interest to the board are: what is the significance and characteristics of the investments that are affected by this change? And how has this change affected companies' investment decisions in terms of nature and type of investment? It would be also useful to know how prevalent is the use of the OCI presentation election and how investors have responded to such choices made by companies. Another question of interest is related to IFRS 9 requirement for reclassification of financial assets if a company changes its business model for managing these assets. These changes are expected to be rare, but it would be helpful to the board to have evidence on circumstances under which companies might reclassify financial assets due to change in business model, and importantly, whether the information disclosed about a reclassification is useful to investors. Another research opportunity relates to the IFRS 9 requirement that only financial assets with cash flows that are solely payments of principal and interest are eligible for amortized cost or fair value through other comprehensive income. Useful evidence here would be whether any financial assets that would generally have been considered as basic lending arrangements have not met the SPPI criteria and why. Another pertinent question is whether these two criteria, SPPI and business model, result in the most useful information that could be provided to investors for particular financial assets. And finally, related to the requirement on how to account for changes in non-credit risk on financial liabilities designated under the fair value option that Laura just talked about, it would be informative to the board to have evidence on whether the information provided about the company's own credit is useful to investors. So with this, we'll conclude the section on classification and measurement, and we have some time to take a few questions. Laura, have we received any questions already?
Yes, we've had a couple. So the first one is an easy one, which I'll take, which was just a question about whether we're going to forward these slides for the participants after the webinar. We're not planning to send them via email, but they are already on our website. I think if you were to go on to the news item for this webinar, then you'll see an attachment to the slides there. The second question I have relates to the last piece of research opportunity Anna just mentioned, so about financial liabilities and changes in fair value due to own credit risk being in OCI rather than in profit or loss to resolve the own credit issue. So they've asked whether we can explain the significance of this change, and then also how the change is expected to benefit the investment community. So maybe actually if I pass to both Rihanna and Anna. So if, Rihanna, if you wanted to talk a bit to the standards, and then Anna, I'd ask if you add anything research specific onto that.
Thank you. So I think just looking at the mechanics of the fair value changes in own credit, as Laura explained before, when own credit deteriorates, it seems counterintuitive to recognize a gain in the financial statements, and that's why the board decided to recognize those own credit or changes in fair value due to own credit outside of P&L but through OCI. And the effect of that was that entities no longer had to make a non-GAAP adjustment to their profit and loss results to exclude those numbers, because we know most entities tended to do that when they presented their results, they excluded it. And so by requiring those fair value changes to be recognized in OCI, at least there was no longer the need to adjust the non-GAAP measures. So, I think from an accounting perspective, that was the outcome of that requirement. But Anna, you may have some information on preliminary research in this area.
Yes, so I mentioned this as an example of a research opportunity, and I'm aware that there is already some experimental research that looks at how investors perceive the two presentation options. So this they look at the own credits being presented through OCI versus P&L, and I think the finding of this research is that investors' assessments of firm performance become less biased when own credit is presented through OCI, and then they, I think this study also looks at whether the presentation format affects varied profitability and so on. But this is just one example of research that provides evidence which is very useful for the future post-implementation review. And so this is the type of research that we would like to see and encourage.
Thank you very much, both. I'm afraid we had a couple of other questions, but looking at the time, I think out of interest we'll move on, and if there is time at the end, we'll continue to take these questions. So if I can hand over to you, Rihanna, to look at the impairment section.
Yes, thank you. And hello to everybody. So as a response to the too little, too late criticism of the incurred loss model in IAS 39, leaders of the G20 encourage accounting standard setters to consider alternative approaches. And specifically, they required those approaches to take into account more credit and macroeconomic information, and also have a more forward-looking nature. So in other words, they wanted the impairment models to be more responsive to changes in credit risk and economic conditions. Interested parties also highlighted the complexity of multiple impairment models in IAS 39. And so IFRS 9 and the expected credit loss model is the IASB's response to those concerns. And the model is a fundamental shift from the traditional incurred loss model that use an absolute threshold for recognizing credit losses. In other words, that incurred loss point, versus using a model that is based on a relative change in credit risk since initial recognition and is more forward-looking in nature. The IASB was also conscious of the level of judgment required in considering expected credit losses, and therefore the model includes enhanced disclosures that would enable users of financial statements to understand how entities have applied the judgments that impact the measurement and the recognition of expected credit losses, but also the nature and the sensitivities of the assumptions they had to make in applying the model. So before we get into the details of the model itself, I thought it was worthwhile just to stand still a bit and look at the scope of the impairment requirements, because it's slightly different from what we had under IAS 39. And so, you know, within the IFRS 9 impairment requirements, we still have the loans that are measured at amortized cost. We've got financial assets, you know, the debt instruments that are measured at fair value through other comprehensive income. And we've got things like trade receivables and lease receivables. But maybe the one noticeable difference is the inclusion of loan commitments and financial guarantee contracts that are not measured at fair value through profit and loss. So even though there's no financial asset on the balance sheet that relates to these loan commitments and financial guarantee contracts, because the instrument itself exposes an entity to the same credit risk that a loan does, for example, those exposures are also included in the expected credit loss model, and so you could have a provision even though you don't have an asset on the balance sheet. So just in terms of an overview of the general model, under IFRS 9, an instrument would be in one of the three stages based on changes in credit risk since initial recognition. So an asset will start in stage 1 when it is a performing asset, so it's not purchase or originated credit impaired. And that just reflects the assumption that the credit risk and the conditions of the borrower are consistent with the assessment that the entity has made of credit risk when it priced the instrument and when it set the terms and conditions of that loan. And so everything is still the way that the entity thought it was when it made the loan. If there has been a significant increase in credit risk, the asset will move to stage 2. So it is, in other words, it's underperforming. It's not in default yet, it's not credit impaired, but it is, things are not the way they were when the entity made the loan, and so therefore there's been a change, and that will change the measurement basis for the ECL from a 12-month expected loss to a lifetime expected loss. And then finally we have stage 3, which is sort of similar to the IAS 39 incurred loss approach, where assets in stage 3 are credit impaired. They are non-performing. And so there the focus on the assets move from a collecting the contractual cash flows more to a kind of a recovery of what we can find or what the bank can recover from the customers. The model is also symmetrical. So in other words, an asset can move from stage 1 to 2 to 3, but it can also move backwards if credit risk improves again. And so if there's no longer a significant increase in credit risk compared to what it was at initial recognition, an asset could move back to stage 1. So it is a fully symmetrical model. It's not just a one-way traffic in that sense, but the evidence needs to be there that an asset has improved or that the credit risk has improved before it moves back. There's been no change to the recognition of interest income compared to what it was on the IAS 39. So that means when assets are on stage 1 and stage 2, interest is recognized based on the gross carrying amount. But when assets are in stage 3 of the model, interest is recognized on the net carrying amount. So in other words, taking into account the impairment allowance. So as I mentioned before, the ECL model is, requires quite a lot of judgment. And, some of those areas of judgment are listed out on the slide. But before I get into it, it might just be worthwhile to clarify that when IFRS 9 talks about credit risk, we are referring to the risk or the probability of a default occurring. We are not talking about the risk of a loss occurring. So when we measure credit risk, we only look at that probability of a default. But when we measure our ECL, we take into account collateral and other credit mitigants, and so the risk of a loss is reflected in the measurement, but not in the staging of the assets between the different stages. So one of the first main judgment an entity needs to apply is around significant increases in credit risk. And that is an important judgment because it will decide how the entity's ECL is recognized, so whether it's 12-month or lifetime losses, and also how those losses affect P&L. And where, applicable, it could also affect the regulatory capital positions. But the judgment in determining significant increases in credit risk is really all revolving around defining the triggers for what would constitute a significant increase in credit risk. And so those triggers could be either qualitative, they could be quantitative, it could be a mixture of the two, and there's nothing in the standard that say you need to have the same indicators across all jurisdictions, across all products, because for some products you may have less information available than you've got for other products, and so you need to make adjustments to those triggers or the threshold for recognizing significant increase in credit risk. And on that point, I think it's also just important to note that significant increase in credit risk does not, it's not illustrating the point at which the bank no longer would lend to a customer. So it's not the point at which the bank makes a no future business decision. It is just the point where the bank is starting to think about the customer slightly different because there has been a change since the asset was recognized initially. Some of the other judgments revolve mainly around measurement of ECL, and that is judgments around the different scenarios that the entity will consider, how the economic variables are being defined, looking at things like the recoverable amount in the case of a default. So in other words, what is my loss given default percentages? And also, what is the point of write-off? Because depending on how soon or how late assets are being written off, that will also impact my ECL. And then, of course, because the model is forward-looking, our expectations about forward-looking or forward future economic conditions has a big impact on the measurement of the ECL. So the first one, just to come back a bit to significant increase in credit risk, this needs to be assessed over the life of the instrument. And so it's not a short-term assessment where we just say, well, what do I expect to happen? Or what is my credit risk expectations about the next 12 months? And this was particularly important during the beginning of the COVID-19 pandemic, where customers were granted payment moratoriums. There was a lot of uncertainty about how the economic forecasts are looking, what the outcome is going to be. And, one of the things that the IASB tried to do at the time, but also a lot of the regulators, was just to clarify what IFRS 9 requires. And one of the main points we've tried to make is to say, just because there is you've granted a payment moratorium to a large range of customers, doesn't necessarily mean all of those customers have experienced a significant increase in credit risk. You need to assess the risk over the life of the instrument. And so there could be, a short-term period, a couple of months, where the client couldn't pay their loans, but the expectation is that when they return to work or when their business is open again, they would be able to pick up their loan repayments again. And so over the life of that loan, maybe there hasn't been such a big increase in credit risk, although the immediate effect of the payment moratorium may seem to indicate that there is. And so I think it's, especially in this case, it's important to remember that the assessment of credit risk is a holistic assessment, and it's based on multiple factors. It's not just a single factor outcome. And that's also what our education material that we published in March, I think, what it said. The other thing, I don't want to say too much about this slide, but what I think this illustrates quite well is that significant increase in credit risk can also be assessed on a collective basis. So where a bank knows, for example, there's a certain industry or a certain segment of a portfolio that may have suffered significant increases in credit risk, although it cannot identify the individual customers, that segment or group of assets needs to be then moved to stage 2, where it would recognize lifetime losses. So it's both an individual but also a collective assessment. And as I mentioned before, there's a lot of judgment, I think, involved in measuring expected credit losses. And IFRS 9 sets out a principle-based approach for measuring ECL. It doesn't prescribe particular methods or methodologies to be used. And so, entities can measure expected losses in a wide range of, using a wide range of measurement methodologies, as long as the 3 principles on the slide are being complied with. And that is that the assessment or the measurement is probability weighted. In other words, it's not a worst case scenario. It's also not the most likely outcome. It is a probability assessment of different scenarios, and there's a weighting assigned to each of those scenarios. And, we've seen banks use 3 scenarios. There's some banks that use 5 scenarios. And I think there's a handful of banks that have even gone with a sort of a Monte Carlo type scenario analysis to measure their ECL. The second principle is that ECL needs to be discounted. And so it needs to reflect the time value of money. And maybe just to highlight that the point of discounting under IFRS 9 is different to the point of discounting that is being done for regulatory purposes. Because for regulatory capital, it's being discounted from the point of collection back to the point of default, whereas IFRS 9 says your ECL needs to be discounted all the way back to the reporting date. So there's an additional add-on of discounting compared to the regulatory models. And the third principle is just around reasonable and supportable information that should be available without undue cost or effort. And in looking at what makes up reasonable and supportable information, it comprises of all three components. So it's got historic information, because historic information is quite relevant in determining where we are going and how our defaults may be driven by changes in economic conditions. Our current expectations are also important because it could be different from the historic information. But then we've also got our expectations about future conditions. And it is those future conditions that, makes the measurement of ECL slightly complex in some situations. But as long as we remember the principles that the information needs to be available without undue cost and effort. In other words, entities do not have to spend a lot of money to generate information or to use information that is not readily available or that they won't use otherwise for credit risk management. But it also means that entities cannot ignore information that is available. So you have to look at everything that is available, but you don't have to, go spend a lot of money to come up with new information, and that's where the undue cost and effort comes in. And also, maybe on this slide, just as a bit of a pointer, when we talk about reasonable and supportable information, we are referring to all kinds of information, all types of information. So it is borrower specific. It could be macroeconomic factors. It could be internal information that the entity itself is generating, or it could also be external information where an entity may purchase information from data providers like Moody's or Bloomberg, but it could also include information that is gathered from peers, so doing benchmark analysis and those kind of comparative studies on peers that have a similar client exposure or a similar size book subject to the same economic conditions. And so all these sources of information could be considered. And, again, just to emphasize that it doesn't have to follow a statistical model or a credit rating process. So there's no need for entities that have a sort of a simple credit risk management process. They don't need to invest in sophisticated credit risk models and systems and infrastructure just to come up with the ECL estimates. And then, lastly, as I mentioned before, the model is quite judgmental, and it depends on the quality of the information that the entity has available. And therefore, when the board developed the IFRS 7 disclosure requirements, those disclosures were made objective-based to reflect the differences in judgment, but also the differences in business model, the risk appetite, the client characteristics, but also the timing in granting loans and determining the terms of the loans. And therefore, you could have two banks that have loans to the same customers, but if the factors underlying those loans are different, then the banks will have different ECL estimates for each of those customers. And that's why the disclosures are so important, because they need to tell the users of the financial statements, how the entity have applied the requirements, what assumptions they've made, what are their definitions of significant increase in credit risk or write-off, and what is the credit concentration that the entity has? Is it a specific industry? Is it around a specific type of customers, like low credit risk or high credit risk customers? And that will depend on the entity's business model. So the disclosures needs to tell that story. The last point, just to briefly touch on, is the transition that the IASB had for especially the ECL requirements. In general, the requirements apply retrospectively. So the entity has to apply it as if it's always been the case. But taking into account that there could be circumstances where entities might not have information available about what the credit risk of that specific loan was at initial recognition when the entity transitioned to IFRS 9, there are some practical simplifications in the standard that says, well, you could use approximations, you can use the low credit risk exemption, you can use the more than 30 days past due rebuttable presumption, and if none of that helps, then you have to assume that your assets are all in stage 2, or that group of assets are in stage 2 of the model, and you apply the model from that point on, but with the exception that those assets can then not move back to stage 1, because if you didn't have the information at transition to assess whether it's a significant increase in credit risk, you wouldn't have the information to say, but that increase no longer exists. And so those were just the ongoing decisions an entity have, or decisions an entity has made on transition that will have an ongoing effect on the measurement of the ECL going forward. So just conscious of the time, so maybe Anna, if I can hand over to you at this point to talk about the research opportunities in this area.
Yes, thank you, Rihanna. So some specific examples of research opportunities related to impairment include on the new expected credit loss model, for example, what is the impact of the IFRS 9 application on financial ratios and reported numbers? Are entities' calculations tied to economic conditions, and how responsive they are to economic conditions? Another question is, for example, whether there is cross-sectional variation in the application of the model by companies, industries, countries. And also an important question is whether the improved measurement of impairments contribute to goals in the long term, such as financial stability. Questions related to the transition choices include what transition approaches have entities adopted, how do these approaches and transition choices vary by type of entity, and what observable market impacts are there. Related to the new objective-based disclosure requirements that were included in IFRS 7 for expected credit losses, it would be useful and informative for the board to know if researchers can observe changes in companies' disclosures and the quality of disclosures, because drafting of the disclosure requirements is different. What factors drive the quality of these disclosures, whether there are any regulatory effects that can be observed, and what are the costs and benefits of the disclosures if these can be also observed by researchers. So with this, we'll conclude the overview of the impairment section. We have just over 10 minutes left for some questions and to conclude. Laura, have we received any questions on the impairment section?
Yes, we have. So the first question I've got here asks would it be useful for researchers to examine how IFRS 9 is performing in times of crisis? It's quite a topical question. Similar to the approach we took earlier, could I ask maybe Rihanna to respond on that, and then Anna as well?
Sure. And I think this is quite a good question because it touches on, one of the principles that we've mentioned at the beginning of the impairment section about what the objective of the model is. Because the objective was to have a model that is responsive to changes in credit risk, both from a customer behavior perspective, but also from an economic perspective. And so, in 2018, when we looked at the annual reports of the banks, we were, everybody said, well, it's really difficult to see how responsive the model is because we've only got 1 year of information, but also economic conditions were quite benign at the time. So now that, there is a bit of movement on the economic condition front and things are not as benign as they might have been a couple of years ago, it would be very interesting, I think, for us to know whether the model is as responsive as we were hoping it to be, but also whether the application of the model is in line with, the spirit of the standard, which is saying reflect the changes in credit risk, both in the staging and the measurement of the ECL. Anna, do you have anything on some indicative research in this?
Yes, just to add to what you said, Rihanna, there is some evidence, early evidence on IFRS 9, a study that examines whether the timeliness of loan loss recognition has changed as a result of IFRS 9, and they find that the timeliness increases, and the result is particularly pronounced for riskier banks and banks that recorded lower loan losses before. So this evidence is very useful. But as you said, the study looks at the 2 years, the year just before the standard became effective and the first year when it was effective. So these years correspond to, as you call them, benign economic conditions, and therefore it would certainly be very interesting and informative to look at this kind of evidence, including the more recent year of that we could call times of crisis.
Thank you. Okay, so I'll move on to another question now, and this is a question about mutual funds, and it says that a company has mutual funds that are available for sale category under IAS 39. And it says that an easy application of IFRS 9 would shift the classification to fair value through profit or loss, which would be a substantial change. And it asks what our views are on that. Can I pass that on to you, Rihanna?
Yeah, sure. And, just to be clear, that we can't really express a view on how to measure assets and what would be the best. But what I maybe can say is that I think with especially things like mutual funds where, your return might be based on the unit price or the performance of the assets within the fund, the consideration of the SPPI characteristics is quite important. And, there is some banks, other entities we've seen where the mutual funds do not pass the SPPI requirements, so it's not consistent with the SPPI. But, we have to be careful not to make a general assumption that none of them would pass because of differences in terms and so on. But the other point is around the business model assessment. And I think, again, a lot of entities have concluded their business model on things like mutual fund investments or unit trusts. Money market funds are more focused around measuring on a fair value basis. So they're managing the assets on a fair value basis. They look at their return based on fair value gains and losses and not necessarily the contractual cash flows. And that would also indicate that, fair value measurement is the more appropriate measurement basis for that investment, and therefore you don't have to go to the fair value option, because managing assets on a fair value basis is one of the reasons that you don't meet the requirements for amortized cost of fair value OCI, and therefore you have to measure it at fair value through profit and loss.
Thanks, Rihanna. I also have another one here that's on classification. This one's about classification for financial liabilities, and it asks about mortgages that are payable, and it asks whether those need to be fair value through OCI.
So I think, again, the answer would be it depends. But if we look at the requirements in IFRS 9, the presentation option to present own credit losses in OCI is only for financial liabilities that are designated under the fair value option. So, in other words, the liabilities would have been measured at amortized cost, but for some reason the entity has designated them under the fair value option, whether it be because of embedded derivatives or an accounting mismatch, or the liabilities being managed on a fair value basis. So that own credit changes only applies to those that are designated under the fair value option. So anything that is still measured at amortized cost under the financial liabilities, for that there's no fair value OCI option, and you just measure the instruments at amortized cost.
Thank you. Okay, so I think that probably is as much time as we have to take questions. So Anna, could I hand over to you to wrap up the session?
Yes, certainly. So I would like to thank you all for listening and participating today, and we hope this session has been helpful. As I mentioned earlier, a recording of the session will be available in due course, and the slides you can access from the website. Again, to reiterate, this webinar is one of a series of webinars that we are holding on each of the three standards, IFRS 9, IFRS 15, and IFRS 16, to engage academics and encourage research for the upcoming post-implementation reviews. A number of opportunities in journals, special issues, and upcoming conferences will provide potential outlets for your research, and we'll release details about these in the news section of our academics page in the next couple of months. We have also included in this slide deck some links to useful resources that are relevant to the topic, and we hope you find these useful as well. And again, on behalf of all my colleagues that participated today, thank you all and goodbye.